Everyone, thank you for joining us today. This presentation is brought to you by Shaila, Sherwin, Yifan, Timothy, Xiao, and Stan. The topic of our presentation is borrowing costs under IFRS and ASPE. So before jumping into the content, please allow me to introduce the agenda for today. Firstly, we'll touch the general background of the four companies, and then we'll look at accounting policies for borrowing costs under IFRS. After that, we'll examine how the four companies account for their borrowing costs. After that, we will look at accounting policies for borrowing costs under ASPE. At the end, we'll restate one of the four companies' financial statement under ASPE. So let's look at the four companies. The first one is Maple Leaf Food. It is the consumer packaged meat company that focuses production on pork and poultry products. Second one, Agrium. It provides fertilizer products to a variety of customers in agricultural, industrial, specialty, and export markets. The third one is Potash Corp. It is an integrated producer of fertilizer, industrial, and animal feed products. The fourth one is Brookfield Canada. It is a real estate company focused on ownership and value enhancement of office properties in major Canadian centers. For accounting policies for borrowing costs is defined by IAS 23. Any cost that is directly attributable to the acquisition, construction, or production of the qualifying asset must be capitalized. Other borrowing costs are recognized as an expense. It is limited by fair value cap imposed through the impairment test. For qualifying assets are those assets that are non-financial and take significant time to get ready for intended use or for sale. These will include inventories, intangible assets, machinery, and other manufacturing facilities. Borrowing costs include interest expense, upfront fee, and foreign currency adjustments. It does not include any imputed interest on the equity. Management has a choice to capitalize borrowing costs in two situations. One, if the borrowing costs relate to inventory that are manufactured in large quantities on a regular basis. The second one is if inventory is carried at fair value. For example, if the company has biological inventories carried at fair value. Capitalization begins when the three criteria are met. The first one is when money is borrowed. Second one, when the payment is made on the asset. And this activity begins that will take the asset ready for use. Capitalization ends when asset is put in use or is ready for its intended purpose. However, it might also end if the work is not progressing, for example, if there's a labor interruption. Interest is calculated using effective interest rate method. For specific loan, identifying borrowing costs is more straightforward. However, for general borrowings, the average borrowing rate is applied to specific expenditures made for the time period incurred. For note disclosures, companies are required to disclose the amount of borrowing costs capitalized during the period, as well as the capitalization rate used to determine the amount of borrowing costs eligible for capitalization. Now we have a general knowledge of how the companies account for the borrowing costs, and then we can look at how the four companies does it specifically. The first one is Maple Leaf Food. Its borrowing costs consist of interest on the company's indebtedness. It is capitalized when they are attributable to the acquisition, construction, or production of the qualifying asset. Qualifying assets are defined as an asset that requires more than 6 months to prepare for intended use. The rate on general borrowing is the company's average borrowing cost. Borrowing costs of non-qualifying assets are expense in the period incurred, which is reported as the interest expense in statement of retained earnings. Here is the strand of the statement of retained earnings, statement of cash flow, and the no disclosure of borrowing costs. The second company, Agrium, its borrowing costs consist of interest on the company's indebtedness. It is capitalized when they are attributable to the acquisition, construction, or production of the qualifying asset. Qualifying assets are the assets that require more than 1 year to prepare for intended use. The rate on general borrowing is the weighted average of borrowings that are outstanding during the period. It does not include any specific borrowing made during this period. Here is the statement of operations, statement of cash flow, and no disclosure for borrowing costs. The third company, Potash Corp, its borrowing costs consist of interest on the company's indebtedness. It is capitalized when they are attributable to the acquisition, construction, or production of a qualifying asset. The rate on general borrowings is weighted average interest rate on all the company's outstanding third-party debt. For borrowing costs of non-qualifying asset, it is charged through financing costs in the period as they incurred. Here's a statement of income for Potash Corp. Note disclosure for borrowing costs. The fourth company, Brookfield Canada, its borrowing costs consist of interest on the company's indebtedness. It is capitalized when they are attributable to direct expenditure on properties under development. For specific borrowing, the amount capitalized is gross costs incurred on borrowing, less any investment income arising on their temporary investments. For rate on January borrowings is a weighted average borrowings that are outstanding during the period. It does not include any specific borrowing made during this period. For measurement, capitalization ceases when there is a prolonged period of disruption of disrupted development activity. The capitalization recovers from commencement of the activity and the actual practical completion. So practical completion is defined as a point completion of construction and the receipt of all necessary occupancy and other material permits. For pre-leased space, practical completion occurs when the tenant improvement that enhance value of the property are completed. So here is the statement of income and comprehensive income. No disclosure for borrowing costs, and no disclosure for borrowing costs continued. So now that we have a general knowledge of how the four companies does their borrowing costs, we actually find some similarities among the four companies. So they all capitalize the borrowing costs when they're attributable to the acquisition, construction, or production of the qualifying assets. And secondly, they all use the rate of general borrowings. They all use weighted average of borrowing that are outstanding during the period. However, we do find some differences among the four companies. For Maple Leaf Food, its borrowing costs of a non-qualifying asset are recorded as interest expense on the statement of retained earnings. For qualifying asset, its definition is asset that requires more than 6 months to complete for intended use. For Agrium, its qualifying assets are defined as assets that require more than 1 year to prepare for intended use. For Potash Corp, its borrowing costs of non-qualifying assets are charged through the financing costs in the period as they incurred. For Brookfield, their specific borrowing amount capitalized is the gross cost incurred on borrowings, less any investment income arising on their temporary investment. Now I will pass on to Stan to talk about borrowing costs under ASPE.
Thanks, Cindy. So now let's move on to the ASPE side. ASPE definition for borrowing costs according to section 3031 and 3061 of the Canada CPA Handbook Part 2 is the same as under IFRS. Any cost that is directly attributable to the acquisition, construction, or production of PP&E or inventory, and that the asset must take significant time to get ready for its productive use. The main difference, however, would be that companies would have the choice to capitalize or expense borrowing costs. That is, the companies may choose to expense borrowing costs if they wish to, although imputed interest on equity is still not capitalized. Similar to IFRS, capitalization of interest stops when the asset is substantially complete and is ready for use, or when there is an unplanned work stoppage such as a strike. And this is similar from IFRS. Capitalization is only allowed for specific borrowings, and the interest can be accounted for using straight line method as well as an effective interest rate method. This is a screenshot from the CPA handbook saying that the borrowing costs are any cost directly attributable to the construction, development, and acquisition, as I mentioned in the previous slide. Regarding the note disclosure under ASPE, section 3031 and 3061 state that if the companies follow a policy of capitalization, they must disclose that policy as well as the extent of interest capitalized. In addition, the disclosure is a lot less onerous in ASPE compared with IFRS. This is section 3850 from Canada Handbook saying that the companies choosing to capitalize borrowing costs must disclose the amount of total borrowing costs that are capitalized. We selected Potash Corporation as a corporation to restate the financial statements from IFRS to ASPE for borrowing costs. Since ASPE allows companies the choice to capitalize or expense borrowing costs, we said Potash Corporation would choose to expense borrowing costs. And we have two reasons for choosing to expense. One, increased interest cost would reduce the amount of taxes paid by the company by decreasing net income. And two, for project purposes, this was the only alternative allowed if we were to state the financial statements from IFRS to ASPE. Let's look at note number 20 in the income statement for Potash Corporation. Previously, as you can see, they capitalized all borrowing costs as indicated by the highlighted parts. Now, these amounts, 79 from 2013, 102 from 2012, and 84 from 2011, are removed from PP&E and instead are added to the finance costs. This slide shows the restated income statement for Potash Corporation. The cost of goods sold is decreased, and that's because of the reduced asset base for PP&E, which I will talk about in the next slide. And as I said in the previous slide, finance costs for 2013, 2012, and 2011 increased because the borrowing costs that were previously capitalized were now added to the finance costs, which leads to a decrease in income before taxes and ultimately net income. Also, the calculation of basic EPS and diluted EPS is done using the weighted average number of shares. The total amount of depreciation is going to change since the asset base has changed. Note 5 states that the depreciation of PP&E was included in two parts, one part being the cost of goods sold and selling and administrative expenses, and the second part being the cost of PP&E and inventory. When the previously capitalized borrowing costs are removed from PP&E, the total asset base will decrease, and therefore the depreciation will decrease. The estimated percentage of depreciation is approximately 5% per year, which was calculated by taking the average depreciation expense per year dividing by the total value of PP&E. And now, let's look at the restated cash flow for Potash Corporation. The adjusted net income figures come from the income statement, which I talked about in prior slides. And as you can see, the depreciation amounts decrease, and that's because of the reduction in the value of PP&E. To continue, let's look at financing activities. Increase in interest costs leads to a decrease in the cash outflow for repayment of and finance costs on long-term debt obligations, leading to a decrease in cash used in financing activities, and which increases the overall cash and cash equivalents. The restated cash and cash equivalents is 698 for 2013, 611 for 2012, and 451 for 2011. Now let's look at the balance sheet for Potash Corporation. Cash and cash equivalents figures come from the cash flow statement, and as you can see, the increased cash and cash equivalents leads to an increase in the company's total assets. However, if you look at PP&E under non-current assets, the value decreased, and that's because of the reduction in the value of PP&E, because borrowing costs that were previously capitalized are no longer capitalized, instead they're expensed. The total assets for the company for 2013, 2012, and 2011 decreased slightly because the decrease in PP&E outnumbered the increase in cash and cash equivalents. To continue, retained earnings amounts are slightly reduced, and that's because of the net income adjustments, leading to a slight decrease in total liability and shareholders' equity. The differences between IFRS and ASPE are due to the differences in tax expense and depreciation expense. Regarding the note disclosure under IFRS, ASPE does not require note disclosure if the company is choosing to expense. They only require note disclosure if the company is choosing to capitalize. However, the company might want to explain why they chose to expense rather than capitalize. That concludes our presentation, and we'd like to open the floors for any questions.